There are two types of investors: those who know how to pick stocks and the others who pretend they know. Warren Buffett is one of the greatest investors of all time, and his stock picking algorithm is highly effective. And this week I found a story by Andrea Frazzini and David Kabiller of AQR Capital Management, an investment fund with a reputation since 1998. They analyzed Warren Buffett's stock picking algorithm in Brock Warren's Buffett Code. In this video, I uncovered something about this algorithm that nobody is talking about: how it works in real life. Their findings illustrate that Buffett's returns appear to be neither luck nor magic, but rather reward for leveraging cheap, safe, quality stocks. The study, which involved decomposing Berkshire's, it's a Warren Buffett fund, portfolio into ownership in publicly traded stocks versus wholly owned private companies, revealed that the publicly traded shares were the stronger performers, therefore suggesting that Buffett's alpha is attributed more to his stock selection process than to his effect on management. The specifics of the algorithm that the researchers derived are complex, and interested readers should consult the study for a full description. The link will be below. In general, the algorithm focuses on what might be called cheap, safe stocks. Those with lower price to book value ratios, those who have exhibited below average volatility, those are from companies whose profits have been growing at an above average pace and which pay out a significant portion of their earnings as dividends. The researchers' study first began circulated in academic circles in late 2013. I read it before, but didn't pay enough attention. But why I mention AQR Capital Management Fund? Because the AQR Large Cap Defensive Style Fund, AUEIX, and they successfully and very closely matched Buffett's performance, gaining about 13% annualized versus 13.5% for Berkshire Hathaway BRKB fund. Look at this graph, they looks very similar. And to illustrate the kind of stock that satisfy this algorithm, the following are those from within the S&P 1500 index that satisfy a number of algorithm-specific criteria. Each has a below average price to book ratio, a below average beta, above average profitability, and about average 5-year growth rate of its profitability, and of course about average dividend payout ratio. The 16 stocks that survived this winning process after selection listed below in alphabetical order. I know you are watching this video because you think about how can apply this Buffett strategy step by step in your real life and not lose money, especially when we see a volatile market like in 2022. First of all, you have to click the like button and then follow Warren Buffett methodology. And don't mess, click first and follow second. Warren Buffett finds low price value by asking himself some questions when he evaluates the relationship between a stock's level of excellence and its price. Keep in mind, these are not the only things he analyzes, but rather a brief summary of what he looks for in his investment approach. First of all, company performance. Sometimes return on equity (ROE) is referred to as the stockholders' return on investment. It reveals the rate at which shareholders earn income on their shares. Buffett always look at ROE to see whether a company has consistently performed well compared to other companies in the same industry. In simple words, ROE is the net income divided by shareholders' equity. Looking at the ROE in just the last year isn't enough. The investor should view the ROE from the past 5 to 10 years to analyze the historical performance. At the second step, Buffett always checks company debt. The debt to equity ratio, D divided by E, is another key characteristic Buffett considers carefully. Warren Buffett prefers to see a small amount of debt, though that the earning growth is being generated from shareholders' equity as opposite to borrowed money. The D divided by E ratio is calculated as follows: debt to equity ratio equal total liabilities divided by shareholders' equity. And this ratio shows the proportion of equity and debt the company uses to finance its assets. And the higher the ratio, the more debt rather than equity is financing the company. Why in 2022, at the beginning of the year, we see a lot of mid-sized and small-sized companies falling like crazy? Because they have a very high debt to earnings ratio. A high debt level compared to equity can result in volatile earnings and large interest expenses. That's what Buffett thinks about this. And you know what is interesting? For a more stringent test, investors sometimes use only long-term debt instead of a total liabilities in the calculation above. The third step in Warren Buffett code is a profit margins. A company's profitability depends not only on having a good profit margin, but also on consistently increasing it. This margin is calculated by dividing net income by net sales. For a good indication of historical profit margins, investors should look back at least 5 years. A high profit margin indicates the company is executing its business very well. But increasing margins mean management has been extremely efficient and successful in controlling expenses. And if you're still watching this video, you could be surprised by fourth and fifth step Warren Buffett does every time. So his first step, he's asking, is the company public for at least 10 years? For at least 10 years. He said he doesn't understand the mechanics behind many of today's technology companies and only invests in a business that he fully understands. And value investing requires identifying companies that have stood the test of time but are currently undervalued. So value investing focuses on a company's financials as the opposite to technical investing, which looks at the stock's price and volume and how the price has moved historically. So never underestimate the value of historical performance. And this demonstrates the company's ability or inability to increase shareholders' value. And one important point to remember about public companies is that the Securities and Exchange Commission (SEC) requires that they file regular financial statements. These documents can help you analyze important company data, including current and past performance, so you can make important investment decisions. And the last step in Warren Buffett investment code is commodity reliance. You might initially think of this question as a radical approach to narrowing down a company. Buffett, however, sees the question as an important one. He tends to shy away, but not always, from companies whose products are indistinguishable from those of competitors and those that rely solely on a commodity such as oil and gas. So if the company doesn't offer anything different from another firm within the same industry, Buffett sees little that sets the company apart. Any characteristic that is hard to replicate is what Warren Buffett calls a company's economic moat or competitive advantage. The wider the moat, the tougher it's for a competitor to gain market share. The value investing style is not without its critics. But whether you support Warren Buffett or not, his net wealth and his success is the best proof.